Alright, today is Wednesday, September 23rd, and this is a review of the stock market activities today. We had a massive red day today, and it is just the beginning of more pain to come. We will cover important subjects and charts today. We have the SPY, the Qs, the dollar index, the VIX, gold, Apple, Tesla, Zoom, Peloton, so stay tuned. And here we go, the Dow Industrial Average in the red, 524.85 points, or a decline of 1.92%. The Nasdaq leading the pack, down 330.65 points, or a decline of about 3%. The S&P 500 in the red, down 78.65 points, or a decline of 2.37%. Switching to the sector's performance, and what a pathetic performance it was across the board. No green closing whatsoever, no metals given today. Leading the decliners, energy, materials, technology. And of course, the woes of energy and materials are correlated to the rally in the dollar index. We'll talk about that in details when we visit the charts analysis. And how did the futures market perform? Soybean meal in the green, lumber closing in the green, coca and lean hogs. However, if you've been paying attention here, futures contracts, meaning the next contract, the majority of these names are declining. That is an indicator for more pain to come in the overall market, including the stock market, but to the economy as well. And the decliners of the day, metals across the board, pain in silver, pain in gold, pain in copper, all of course related to the move in the dollar index. And we see OJ closing in the red as well. Again, when you look at future contracts, we have seen lots of declines today. This is a very important indicator. And now, moving on to the big casino, the gambler's market. Apple at number 1, 1.8 million options traded today. 67% of those were calls. What's new? Tesla at number 2, 1.3 million options traded today. 54% of those were calls. And by the way, we have witnessed a massive amount of decrease in open interest in Tesla calls. The 500, the 600, the 450, the 420, even the 400, they're being closed. Traders are succumbing to the wounds, admitting defeat and moving on. All the hype from Battery Day turned out to be the biggest trap. As predicted, of course, but don't expect the culties to understand that. And at number 3, Nikola, 400,000 options traded today, 30% of those were calls. Notable action today, of course, in Peloton and Zoom. And I've been saying, until and unless Peloton and Zoom are hit by the correction is not over yet. And what we've seen today is the morons stampeding in the morning, going Naruto style, buying Peloton and Zoom. Who cares about valuations? Who cares about technicals? Who cares about what's going on in the rest of the market? The morons think that they figured it out. The Robin Hoodiots stampeding in the morning, buying the 100 call in Peloton and the 520 call on Zoom. And what did yours truly do? I did buy puts the moment Peloton hit 100 and the moment Zoom hit 520, and you know what happened next. Moving on to the headlines that shaped the day. And of course, the first headline from yesterday, we know what happened with the promised and most anticipated Battery Day. The cult followers been hyping up and anticipating Battery Day and what Reverend Elon Musk is going to reveal, pouring all their money and all their savings on weekly calls expiring by the end of this week. Way out of the money calls. We're talking 500 and 600, even the 800, showing that these morons have no clue about what they're doing in the market. They think it is a video game and stocks can move 20-30% every day. And of course, you saw what happened immediately the sell the news phenomena in Tesla. Reverend Elon, again the con man that he is, made a bunch of big promises and recycled some promises he made years ago. 2 years ago he said we will produce a $25,000 car in 3 years. Yesterday he said the same thing. So he keep pushing the ball and the post further away. And of course, I'm old enough to remember what happened to the battery swap back in 2013. It never happened. And the robo taxis that we're supposed to have now in 2020. Reverend Elon just makes empty promises, big promises, bold promises, and delivers way past the schedule if he delivers at all. Furthermore, competitors are coming for Tesla's neck. Combine that with the extreme, absurd overvaluation of the stock, and you saw the reaction of the stock today, basically saying we don't trust Elon, we don't think he will deliver on those promises yesterday. And of course, Tesla stock is a pyramid scheme. You know all these YouTubers who keep pumping Tesla stock. They bought it early and they have a gambling habit of buying the stock and buying options on the stock. And of course, they use their viewers to funnel money in the stock, push it higher so they can get richer. And watch how these YouTubers, now that Tesla's declining, watch how fast they will dump content in their channels so they can make money and compensate for what they lost from their gambling habit on buying Tesla calls. Be careful who you trust and who you watch. Most of these guys are scumbag, scam artists. Moving on, we've heard, of course, in the morning about the news, the vaccine news. It is a new trial from Johnson & Johnson, moving to the most important phase of the trial with over 60,000 participants. And this is important because it is a single dose treatment. I told you on Monday, I don't trust the move in tech and momentum, and I don't trust the decline in the reopening stocks. I think that the move in tech and momentum is an opportunity to short, and the move in the reopening stocks is an opportunity to buy. But you have to give the decline time to finish its course. And I also said it is just a matter of time before you see another vaccine headline. And there you go. Today we have the vaccine headline from Johnson & Johnson. Moving on to the Federal Reserve, we've heard from many speakers today and yesterday, but notably, of course, Fed Reserve President of Cleveland, Mr. And she suggested that the Federal Reserve should open accounts for every US citizen and send money digitally to us, the people. And now you understand, of course, the whole scam of employment and money and all that garbage. If the Fed is just gonna print the money for us, send it digitally, why the hell do we need jobs or work or anything like that? Just send $1 billion each to every American. Problem solved. The Federal Reserve, of course, has no clue or no plan or exit strategy to build a real economy. They figured out how to bail corporations, creating zombie companies by printing the money digitally and sending it to any public corporate entity that needs it. And now they're saying, hey, after we've done that with trillions of dollars, we haven't solved the employment problem yet, or rather the unemployment problem. And now they're saying, hey, why should we bother with employment? Just send the money, press a couple of buttons, and you make every American a millionaire overnight. I have no problem with that plan whatsoever. And of course, we heard from Vice Chair Clarida saying that the Fed will not increase rates until inflation rises above 2% for a few months at least. Refuting, of course, what Fed President, the Chicago Fed President Evans said yesterday when he slipped and said there are no restrictions in the Fed's plan that prevent us from hiking rates anytime if inflation reaches anywhere above 2%. So the Fed personalities are stumbling all over the place. We know that aside from negative rates and controlling the yield curve and straight out buying stocks, they're out of ammo. They got no plan. They're confused. They don't understand how the economy didn't recover after all the tsunami of liquidity they flooded the market with. Oh gee, how come all the trillions of liquidity we flooded the market with, how come that didn't trickle down to average people? We can't figure that out. And of course, moving on to Jamie Dimon, the beloved CEO of Chase Bank, who got caught, by the way, washing money for drug cartels and mobsters in the FinCEN revelations. Jamie says while he approves of paying more taxes for rich people like himself, he suggested that wealth taxes are not reasonable and are impossible to achieve. Of course, they're impossible to achieve if you've been washing money and hiding it in Ireland and the Cayman Island and all the cute tricks that these bastards do to stiff the country away from revenue. Of course, they don't care if Biden or Trump wins or whoever. They know that taxes will go up on their class because we have a $3 trillion budget deficit that has to be paid somewhere. The rich must be taxed. They understand that. But what they're going to do, of course, is they're going to sell their stocks this year so they can lock the lower rate, and they're going to reduce their salaries and their options, and they're not going to sell any stocks while taxes are high. And they're gonna avoid paying any taxes effectively. And Jamie here saying, hey, don't come after my unrealized capital gains or anything in my bank account because that is not realistic. Notice how these guys always pound at the chest claiming patriotism when they send your kids to wars, to die in meaningless wars. But when their turn comes to stand up and pay back for the country that they so claim to be patriotic to, all of a sudden they don't want to pay. Well, somebody has to pay because we have racked an enormous amount of debt, trillions of dollars, and we do have trillions of dollars in budget deficits alone. And the last bit of news, of course, CNBC's Jim Cramer. Jim Cramer saw the rebound on Monday and he declared that the correction is over and it is time to put money back to work, and the valuations of Apple and Google and Microsoft and Facebook are attractive again. This guy has no integrity whatsoever, and he flip-flops more than a pancake, switching based on whatever the market did. Yesterday he was bullish. Today he will be bearish. Don't trust this snake with whatever advice he gives. Moving on to the heat map analysis, and it was a sea of red, as you can see. Very few names managed to make it today in the green. Notably, right away, Nike, you see the big box of Nike lighting up in the green due to the earnings. And of course, some people shorted Nike before the report and they were forced to cover. That was a reason, among many other, of why Nike rallied today. You also see Twitter hidden right there in the communication services, and of course in technology, one notable green box, very tiny box of Western Digital. Of course the stock suffered significantly and lagged. All of a sudden today it felt like rallying alone. Moving on to the rotation trade, and it was a sea of red on both sides of the aisle. I did title my conclusion on Monday as "There is nowhere to hide," and you're seeing this happening right in front of you. There is nowhere to hide. The way the technicals and the market is set up, it is predicting a massive correction, a massive drop that will not spare any sector in the market. It is the biggest operation to shake out retail traders since the year 2000. However, unlike consensus, which says that momentum stocks and technology stocks will recover after the drop first, I do believe that the reopening stocks will recover first instead, and technology and momentum will lag for a while, even after the drop is finished and the bottom is formed. And that is due to a surprise stimulus deal or a vaccine announcement. Furthermore, if the correction hits the market overall, the majority of the money in the market is concentrated in momentum / technology stocks. They will act as an ATM where cash comes out of, and now money managers and institutional investors will have to reassess. Where should they put that cash to work. Back again in technology, that is a possibility, but it is doubtful in my opinion. I think that they will find a value in the names that have been lagging before the correction and now have some tailwinds in terms of a stimulus and a vaccine announcement. And of course, notable in your left-hand side, the momentum names, you see Peloton and Zoom outperforming again. I will repeat, the correction is not over until Peloton, Zoom, and add to that mix DocuSign are cut in half, at least. So watch out for these names. And now moving on to the charts analysis, starting with the S&P 500, the SPY. Here is a daily perspective, and as you can see, we have closed below the important resistance/support line of 333. That is very bearish, and it is a signal that we will look for support in the southern destination, meaning more decline to come in the market. And the next support I see is the 311 area. That would signal a drop of about 3.6% from where we are right now. If that doesn't work, the next destination is 286, the area of 286. That would be a drop of about 11% from where we are and where we closed today. And of course, that is the best case scenario. Looking under the hood, 15 minutes chart. We've talked about the gap and the importance of the gap. And I said yesterday, a reversal from the gap, a failure to close above the gap will trigger a shorting/selling signal, and you'll see a flush down in the indices, specifically the SPY and the Qs. Exactly what happened today. The SPY failed at the gap and it flushed down for the remainder of the day. Moving on to the Qs, a daily perspective. We have reversed significantly of what traders like to identify as an engulfing candle, removing the entire move of yesterday. Very bearish, signaling more pain to come. The next destination, 237. Sounds extreme, and you might see many bounces here and there, but this is the destination the market wants to go down and visit. It is another 10% decline from where we are right now. And of course, viewers of this channel knew that the bounce was a dead cat bounce to begin with, because of course we looked at the weekly chart of the Qs. And I said that once we crossed to the negative territory in the MACD, that was a signal of the end of the trend. And I compared it to the burst of the bubble of 1999, and I showed you the similarities there. It doesn't matter to me from a daily perspective whether the Qs bounce or not. The micro picture I'm not concerned about. The macro picture from a weekly perspective, the MACD, says the trend is over, the correction has started, and there is more pain to come. And of course, when we look under the hood from a 15 minutes perspective, we talked about the gap again yesterday in the Qs. What do you know? The Qs didn't even bother making it all the way to the gap. It decided to reverse before that. That was your signal right away to sell and to short the Qs. Whether you buy puts in the Qs or you buy the short triple Qs. I ended up, of course, buying calls on the short triple Qs the moment I saw the reversal from the gap today. And now moving on to the chart that's been shaping the market recently. King dollar. Whatever the dollar does, the market will follow. We've been saying that the dollar is an indicator here, that the last few days were just a dead cat bounce because the marsh and the rally in the dollar. Today, you saw the continuation of the move higher in the dollar impulsively. This is what happens when you finally break consolidation in any chart. You release the energy. And of course, we've predicted that easily from looking at the weekly chart of the dollar index, specifically looking at the MACD. Once the crossing happened, crossing the average, making green impressions in the histogram, that was your signal that the dollar would rally, and that would translate into pain for the stock market. Technicals matter. That is the lesson of the day. Moving on to the VIX. And the VIX made a very interesting move today. If you were paying attention, you scored big on the VIX today. It went all the way very close to the support line, and then it reversed higher. Reversing before reaching support is a very, very bullish signal. Likewise, reversing before closing a gap higher or before reaching a resistance line is very bearish. It works both ways. The moment I saw the reversal in the VIX before reaching the line and marching higher, that was your signal to buy the VIX and to raise more gains to come for the VIX. Significant gains. That is at least my perspective. And moving on to the chart of gold from a weekly perspective. A rally in the dollar translates to pain in gold. That doesn't mean that the long picture in gold isn't bullish. Matter of fact, it is bullish. And you see from a weekly perspective, the chart of gold is very healthy. It is visiting and revisiting the center of gravity of any chart, the king of all indicators, the 20 weeks moving average. Remember, you cannot diverge from the 20 weeks moving average and prolong the divergence without crashing and coming back to revisit the 20 weeks moving average. And of course, gold will not start to rally unless we see the movement in the dollar frizzling out and you see the dollar reversing back to the southern destination. That would be your sign and your signal to buy gold. Now, what happens if the reverse scenario takes place? Meaning, what if we wake up tomorrow or next week seeing that gold is rallying along with the dollar index? That would be your signal that the dollar index will reverse and move to the right destination very soon, and that could coincide with a market bottom. But for now, more pain for gold in the horizon. Moving on to the chart of Apple. Remember, Apple never closed below the magic number of 106. It creeped below it, but it never closed beneath that number. Closing below 106 in Apple will trigger a domino effect that will flush down Apple shares all the way back to about 96, the area thereof. That would be another 10% or so decline from where we closed today. Any smart and seasoned trader will look at the chart of Apple, and if it does close below 106, you will understand that you will see more pain, significant flushes and pain in the overall market. And now, moving to Tesla, a weekly chart, you can see that the MACD in Tesla is finally crossing the blue line average and making red impressions in the histogram. The week is not finished yet, but if we do close the week and we do close making a red impression in the histogram, understand that there will be significant pain for Tesla shares in the next few weeks. And the next destination would be 285. That is about 40% decline from where we are right now. That is not extreme at all. Remember, last time Tesla chart from a weekly perspective crossed the MACD to the negative territory, making red impressions, Tesla declined over 63% from the highs. What to say that we are not going to see at least 40% decline from the top? Very reasonable, on the table. Watch out for that one. And moving on to the chart of Zoom. You saw right away, if you were watching the chart of Zoom in the morning, the stampede and the Naruto style rush hits first, buying Zoom stock. Don't expect the morons to understand valuations or financial analysis or technical analysis. That doesn't matter to them. It is go Naruto style first, ask questions later, after the decline happened. Watch any forum about Tesla stock. The morons continued to hype and they bought the stock, and now they're asking questions after the decline. What happened? I thought Elon came out with all good news. Why did the stock decline? Why the crash? And I respond, why the hell are you in the stock market? You do not belong here yet. Keyword yet, until you educate yourself on how to trade and invest in stocks properly. And back to Zoom. After the Naruto style run, pushing the shares all the way to 530, you saw the reversal and the decline on Zoom shares right along the market. And when you look at a 20 weeks chart, Granted, the stock is new, however, we are diverging way above the center of gravity, the 20 weeks moving average. And we have about 47% decline to go to correct the chart and make it technically sound. Putting, of course, Zoom's valuations aside. I see more pain for Zoom here. Remember, the executives of Zoom been dumping shares for weeks now. Even they know that the valuations are out of whack. And of course, they take the money from the moron traders, the Robin Hood idiots. They get richer in the process and they leave them holding the bag. Moving on to the chart of Peloton, 15 minutes perspective. You see the Naruto run right in the morning, stampeding over each other, asking questions later, pushing the shares all the way a little above 100. And what do you saw? If you've been watching the options market, it told you that the 100 level is a ceiling. After that number, there is no gamma squeeze. And what do you know? The shares reversed right away. More pain to come in Peloton. And now let's move on and conclude the video. I am pissed off because the stupidity of the moron traders and the Robin Hoodiots. I've been chatting with a bunch of them today, and when you tell them about Peloton and Zoom and Apple and Tesla and all the overvaluations in the market, their response, of course, is very naive. Either it is, oh, but everybody I know is buying Peloton. Everybody I know uses Zoom. Everybody I know likes Tesla. But Elon is the future, bro. But Apple is gonna be 5G. I even heard stupid arguments saying that stock A is cheaper than stock B because it has a lower price. Unfortunately, the lack of education in this country, proper education that is, creates that kind of thinking where traders who invaded the market recently pay no attention to valuations whatsoever. They don't even understand what valuations mean. These zombified traders are programmed on autopilot buying, and they think a stock price is somewhat of a video game score where a stock price can go from 90 to 100 to 120 to 500 to 1,000. It's just a game. They don't understand that the stock price is tied to the outstanding shares. You multiply price with outstanding shares, you get a company's valuation. A stock that is 20 bucks could be more expensive than a stock that is priced at 100 bucks due to the value fucking wation. How could you not understand that? I have no hope for these Robin Hoodiots and these morons to understand the trade and to understand the market and trade wisely. I have absolutely no hope whatsoever. The only thing that can happen now is for the market to take its course. Market Darwinism. What is market Darwinism? Survival for the fittest and most disciplined. The gambling crowd, the amateurs, the Robin Hoodiots will all be flushed out of the market in the most violent way you've ever seen. They had their chance to learn, they didn't, and now all they've done is push stock valuations higher where executives can dump shares, become richer in the process while they're left holding the bag of losses. The stock market has a reverse Robin Hood mechanism if you don't know what you're doing, because money is funneled from the poor and the middle class, from retail traders all the way to the rich and corporate executives who sell their shares, cash out, and they leave retail traders in the dust. That is all there is. It is a wealth transfer mechanism from the have-nots to the haves, due to the stupidity of the have-nots.
If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.